Let us see how do we land up calculating the three performance parameters of a company. And then later on we will see how we take operational decisions based on these three. So the three company performance parameters are net profit, ROI and cash flow. Let's take net profit. We learned that throughput is all the money that is retained within the company. All the money paid to vendors, subcontractors, anything is not the money of the company and it is not considered as throughput. So if I take all the throughput, the money retained within the company, it is from this I have to spend, which is my operating expense. Whatever is left is my profit. So net profit becomes throughput minus operating expense. This is for a period. I know how much of expense I will make in a period. I also know how much of throughput I have made in the period, because only if the sales have been booked have I made a throughput, otherwise there is no throughput. So net profit is throughput minus operating expense. Let's go to ROI. Return on investments. What is the return? The profits I have made. What is my investment? All the money that I have put into the company. Raw materials, machines, plant, building, anything and everything is my investment. So throughput minus operating expense divided by investment I is my ROI. Okay. Now it is rolling. ROI every month? Yes, every month. What happens if I bought some raw material which I did not convert into finished goods and sell? Where does it go? It remains within the company as an investment. The only thing is the investment by the end of the month has gone up. So ROI for that month has gone down. What you need to see in both net profit and ROI is the trend. Does the return on investment month on month keep going up, or is stationary, or keep going down? Is my net profit constantly going up month on month, or is this trend flat? How would I know what is my cash flow? Cash flow is the money that I've got into my company, right? Minus the operating expense, which is my profit. But this is a profit not booked or the profit booked. But I may have spent more money. Where? In buying material which I did not sell, but I have to pay for, which is nothing but change in investment. So any change in investment month on month is nothing but cash eaten up. So I'm able to explain all the three performance measurements of my company by using just these three. However, there are more measurements I can draw by just using these three. What is my productivity? And this is one of the most critical and the best aspect of throughput world. In cost world, we were having so many measurements. There was a labor productivity, there was a material efficiency, there was a capital efficiency. Here is just simple productivity. And productivity is defined as total throughput generated divided by the total operating expense. or rather just operating expense, because operating expense means total expenses. How does this productivity give me a better figure than the three independent productivity measures that are usually used in other parts of cost world? This operating expense that we're talking about has a factor inside it which is called the interest that I pay to the bank. That's my operating expense. This operating expense also has a factor which takes into consideration my rejections or my quality or my material. This operating expense has a component of salary, overtime, subcontracting, anything that I do. So in case one of the three core elements of manufacturing, that is labor, material and capital, is showing efficiency at the cost of other, this productivity measure will capture it. So the job is, for the same operating expense, keep improving throughput. What does operating expense mean in day-to-day decision making? Let me take operating expense. One of the prime reasons for simplifying measurement was that it should aid in decision making. Like I earlier mentioned, that we should be able to tell everybody in the organization the direction in which these measurements should be forced to move. We saw a conflict arise earlier because at some point in time we wanted inventory and other we didn't want. In a throughput world, we are very clear in which direction these measurements should go. And second to that, there is a priority on these measurements. Let me first sequence these measurements. The top priority is throughput, then is inventory or investment, then is operating expense. So when somebody starts thinking, they have to first focus on how to improve throughput, then how to decrease inventory, and only then think how to decrease the operating expense. Whereas in the cost world, the prime driving factor was how to reduce operating expense and then how to reduce inventory. Just imagine, after years and years of hard work, the empirical data says that the best of the companies have not been able to reduce the operating expense by more than 5%. And if anybody has, they are called outlandish. It is extremely tough to reduce your operating expense by more than 5%. However, if you want to improve your throughput, you can, sky's the limit. Why 40%, 50%? It can go by 100%. So why are you focusing on something which will only result in 5% saving? And if you are able to improve your throughput by 40% while keeping your operating expense constant, your bottom line as it is will go up multiple times. So in a throughput world, the prime focus is on throughput. Then, after you have made sure that the throughput is not compromised, please focus on maintaining this throughput or increasing this throughput while decreasing the inventory. And then focus on operating expense while increasing the throughput, reducing the inventory, reduce operating expense. How does operating expense guide decision making in day to day? What does operating expense include? Operating expense includes everything: salary, consumables, overtime, canteen charges, electricity, interest expenses, depreciation, rejection. Now, if operating expense means all of this together, how do you take decisions on reducing operating expense? You can reduce operating expense by reducing rejections. You can reduce operating expense by reducing salary bills. Let me take another example. In the throughput world, do you think you have reduced operating expense if you have stopped a changeover? In the cost world, yes, we saved cost by saving setups. Have you actually reduced operating expense by not doing a setup change? Or will the cost go up if you are doing a setup change? In fact, in the throughput world, you lose throughput if you don't do setup change. If you don't do setup change, you don't produce the product that you can sell. And if you produce more than you can sell, as it is, it doesn't get booked as a throughput. It gets booked as inventory. So if in doing a changeover, you have not paid extra salary, or you have not paid extra electricity charges, or if you have not spent extra on consumables, actually setup change has got no impact on operating expense. However, a setup change has an impact on throughput. And in throughput world, what is the top priority? Throughput. Our behavior from the cost world to the throughput world suddenly seems to be 180-degree opposite. The utilization measurement in cost world forced us to avoid setup changes, have longer runs so that we could show more utilization of machine. And that more utilization of machine was assumed to save company the money. However, in the throughput world, we say that it doesn't cost us anything to do a setup change. But if we don't do setup change and miss the delivery of an item, we are losing throughput, which is a bigger crime than saving cost. Let us say now you produce something that you cannot sell. It definitely doesn't impact throughput because you can't sell. What does it impact? If the quality is good, which you can sell later, you've done nothing. Only the operating expenses happen. Because in the throughput world, we assume the cost of the finished good inventory to be nothing but the cost of the raw material. So in the throughput world, what you have done is you have taken raw material, spent some money on it in the terms of operating expense, and put it in a different location. That's it. So operating expense has actually gone up, which technically should not have, but you have spent it and nobody's paid you for it. Now how will you behave? Operating expense makes you behave that please do not overproduce. But in the cost world, if you overproduced, it actually reflected in better utilization and it gave you more marks. So if you overproduce in a throughput world, it just increases the operating expense, does not increase your throughput, and hence it is a wrong decision. Operating expense means all the money a company has spent on converting inventory into throughput. If not converted into throughput, only the operating expense gets booked, but the company does not make any money, which will actually later on impact its cash flow. Operating expense in throughput drives a different behavior, and the behavior is to make sure that you constantly sell. That means constantly throughput is generated.